You've been told that becoming a better investor means learning more about the market, which stocks, which sector, which moment to step in. The best-selling money book of 2017 barely mentions any of that and spends 250 pages on something else entirely, on the people, the products, and the habits sitting between you and your own money. Here's the number it's built around. The average actively managed mutual fund costs about 3.17% a year once you count everything, and past 4% if you hold it in a taxable account. Call it $3,100 annually on $100,000, against roughly $58 in an index fund. This isn't a book about the market. It's a book about the silent partner, the one taking a cut of your account every year, in good markets and bad, whether you notice or not. And by the end of it, you'll know all four of its faces. Start with why financial advice is unlike almost anything else you buy. Buy a car, you can drive it, hire a plumber, and the leak either stops or it doesn't. But advice has no such test, because the product is a claim about the future, sold by someone whose pay you can't see, measured against a benchmark nobody ever showed you. So the industry graded itself, and for most of a century, the standard governing the person selling you investments wasn't a duty of loyalty. It was suitability, a legal test asking only whether a product was broadly appropriate for somebody in your situation, never whether it was the best one available, and never whether the seller earned more for recommending it. You can measure the fog this creates. In a 2011 AARP study, 7 in 10 401k participants believe they paid no fees at all. About 3 in 5 had no idea what they were paying, and fewer than a quarter said they paid anything. Most people ask which fund, which manager, which year to get in. Tony Robbins and Peter Mallouk spend the whole book on a different question. Who gets paid what for the answer? But they don't open on fees, they open on fear. The first section is 7 claims the book calls the freedom facts. And the job of all 7 is to turn market panic into weather. A correction is a drop of 10% or more. And since 1900, corrections have arrived roughly once a year. They last about 54 days on average, which is under 2 months, and fewer than 1 in 5 turns into a bear market, a fall of 20% or more, while bear markets themselves show up every 3 to 5 years. Every single one in American history has so far been followed by a bull market. Think about how you treat actual weather. You don't sell your house because it snowed in January, because you know January is coming and you own a coat. And that's the whole psychological move the book is making. Winter arrives on schedule, so a portfolio built to survive winter never needs anybody to forecast it. Then comes the statistic the book leans on hardest. From 1996 through 2015, the S&P 500 returned an average of 8.2% a year. Miss the 10 best trading days across those 2 decades, and your return drops to 4.5%. Miss the top 20, it's 2.1. Miss the top 30, 30 days out of about 5,000, and 20 years of returns go to 0. The danger isn't the crash, it's your exit. And the claim got tested almost immediately, 3 times inside 5 years. In February 2020, the S&P fell about 34% in 32 days, the fastest bear market ever recorded. 2 years later, it ground down 25.4% across 9 months, slowly enough that there was never a single obvious day to panic on. In April 2025, tariff headlines dragged it more than 21% below its February high on an intraday basis, without ever closing in bear territory. All 3 recovered. So if staying put is the whole trick, why does the book spend its angriest chapter somewhere else? Because staying put doesn't protect you from the one thing that takes money in every market, up or down, every single year. Meet the first face of the silent partner, the Fee Iceberg. Here's the story you've been told. You pay for professional management because professionals beat the market, and their fee is the price of that edge. It sounds reasonable, convincing even. You'd pay a mechanic rather than rebuild the engine yourself. But the numbers don't cooperate. Robbins points to a study by Robert Arnott of Research Affiliates, who tracked every actively managed fund holding at least $100 million, 203 of them, across the 15 years from 1984 to 1998. 8 beat the index. 8 out of 203, under 4%, which means 96% of the professionals lost to a portfolio a machine could run for nothing. That finding has only hardened. S&P's own scorecards now show roughly 9 in 10 American large-cap funds trailing their benchmark over 15 and 20-year windows. And Morningstar found that, across the decade ending in 2025, only 21% of active funds both survived and beat their index peers. So the fee isn't the price of an edge. It's charged on your assets, not on your results, which means it arrives in the winning years and the losing years identically. And it's bigger than the number you were shown. Robbins builds the iceberg out of a Forbes analysis, and the construction is the lesson. Above the waterline sits the expense ratio, the only figure most investors ever see, averaging about 0.9%. Below it sit transaction costs, the commissions and spreads a fund pays every time its manager trades, estimated by academic research at 1.44% a year, and printed in no prospectus. Below that, cash drag, the return lost on money the fund parks in reserve, about 0.8%. Stack them, and the visible fee triples to 3.17%, and the tax bill in a taxable account adds roughly a point more. Now picture what that does over a working life, because it isn't a bite taken once. It's a slow leak in a bucket you keep refilling for 40 years, and the water you lose is the water that would have compounded. But a fee is only the price of the product. The harder question is who handed it to you, and what they earned for doing it. Which brings us to the second phase, and the book's sharpest chapter, the Fiduciary Gap. Robbins answers with a headcount. Of roughly 309,000 financial advisors in America, only about 31,000, 1 in 10, are registered investment advisors, the category that carries a genuine fiduciary duty, a legal obligation to put your interests first, then the trapdoor. Of those 31,000, as many as 26,000 are dually registered, meaning they can act as a fiduciary in one conversation and as a commissioned salesperson in the next. Picture a referee who's also on one team's payroll, allowed to switch hats mid-game without telling you which one he's wearing. Subtract them, and about 5,000 advisors are left. 5,000 out of 309,000. 1.6%. That's the book's real thesis. Not that Wall Street is stupid, but that these incentives are working exactly as they were built to work. The practical instruction is simple, and it's the most useful page in the book. Ask the person managing your money whether they are a fiduciary 100% of the time. Ask how they're paid, by whom, and whether they receive anything at all for putting you into a particular fund. Look at the bottom of their website for the line about securities being offered through a broker-dealer, because that sentence is the tell. And don't wait for a law to do it for you. A Department of Labor rule requiring anyone advising on retirement money to act in the client's best interest was finalized just as the book went to print, and Robbins warned readers in print that it might be rolled back before it ever took effect. It was in 2018, and a narrower version arrived in 2024, was blocked within months, and was formally vacated in March 2026. 4 attempts, 16 years, nothing enforceable at the end of it. So the book stops waiting and hands you a portfolio instead. It's called The Core Four, and Robbins assembled it out of interviews with 50 people who move real money for a living. Principle 1, don't lose. Buffett's first rule is not to lose money, and his second is to remember the first, and the reason is arithmetic, not attitude. You walk down the stairs, but you climb back up a ladder. A 50% loss needs a 100% gain just to return you to even. Principle 2, asymmetric risk and reward. Paul Tudor Jones hunts for $5 of upside on every dollar risked, which means he can be wrong 4 times out of 5 and still break even on the 5th. Buffett built the same shape into 2008, putting $5 billion into a special class of Goldman Sachs preferred shares carrying a 10% dividend. So he got paid to wait while he was right. Principle 3, tax efficiency. The third face of the silent partner, and the only one with a government behind it. A return quoted before tax is a menu price, not the bill, and the only number that matters is what lands in your account after the government's share. Principle 4, diversification in 4 directions. Across asset classes, so no single one can sink you. Within them, so no single company can. Across countries and currencies, because a portfolio confined to one market is a bet on one government. and across time, buying steadily rather than in one heroic lump, the way you buy groceries every week instead of gambling the year's food budget on Tuesday's prices. 4 principles, though, are just a filter. What you actually need is a plan for the day it all goes red. Mallouk's answer is that surviving a bear market is 90% preparation and 10% composure. And preparation means 5 specific things. Your asset allocation, the mix of stocks, bonds, and alternatives, is the most consequential investment decision you'll ever make. And the book is blunt that it matters far more than any individual pick. Index funds go in the core because they buy the whole market cheaply instead of paying someone to guess at pieces of it. You keep a cushion of safe money set aside so that a bad year never forces you to sell at the bottom. That cushion is the difference between a paper loss and a permanent one. You explore at the margins, if you want, with a slice rather than the whole, and you rebalance on a schedule, once a year or whenever the mix drifts. Rebalancing is the quiet genius of the book, so sit with it a second. If you start at 60% stocks and 40% bonds, and stocks crash until you're at 45 and 55, rebalancing makes you sell bonds and buy stocks, buying the thing everyone is running from. It's a thermostat. It acts when the room drifts, not when you feel cold, which is precisely why it works. That's how a crash becomes a purchase. Buffett put it plainly in October 2008 while he was buying, "Be fearful when others are greedy, and greedy when others are afraid." David Swenson warned Robbins that whatever you own, someday it will fall 50 to 70%. The point of all this preparation isn't to dodge that day. It's to make sure you're a buyer when it comes, instead of a seller, which leaves the 4th face of the silent partner. And it isn't an institution at all. It's you. Section 3 is called The Psychology of Wealth, and it names 6 ways your own head takes your money. 6 habits that don't care how good your plan is. Confirmation bias, where you read only what agrees with you. The investor who owns a stock and reads only the bulls. Recency bias, where the last 6 months become your forecast for the next 30 years, like judging the climate from last week's weather. Overconfidence, where nearly everyone rates themselves an above-average driver. Greed and impatience, chasing whatever just went up. Home bias, the pull toward your own country's market simply because it feels knowable, which is the investing version of only ever eating on your own street. And loss aversion. Kahneman and Tversky's finding that losing $100 hurts about twice as much as finding $100 feels good. That last one explains almost every panic sale in history. Robbins' answer isn't willpower, and this is the sharpest idea in the book. Willpower fails in exactly the conditions where you need it, so you build systems that don't require any. Automatic contributions, so saving happens before you can feel it. A written checklist, so the decision is made in the calm and executed in the storm. A fixed allocation and scheduled rebalancing, so falling prices trigger a purchase instead of a debate. And a fiduciary advisor whose real job, in this framing, isn't returns at all. It's being the friend who holds your car keys at the party. Then the book does something no other investing book does. It stops talking about money. The final chapters argue that all of this was in service of something a balance sheet can't hold. Robbins claims you live in one of 2 states, a beautiful state of gratitude, curiosity, and drive, or a suffering state of stress, resentment, and fear, and that the state you're in is a decision about where you point your attention, not a report on your net worth. Wealth without that decision, he argues, is just a bigger number attached to the same anxious person. He put his money where that argument was. Robbins directed the book's proceeds to feeding the hungry, and his partnership with Feeding America delivered more than 101 million meals in 2016 alone. So here's the whole book, in the order it arrives. Corrections come every year and almost never become the disaster you fear. The fees you can't see cost several times the fee you can. And 96% of professionals still lose to the index. Only 1.6% of advisors owe you undivided loyalty, and no law has managed to fix that in 16 years of trying. 4 principles decide what you buy. Preparation decides whether a crash is your worst year or your best one. And 6 mental habits decide whether you follow any of it. Being unshakable in the end isn't confidence. It's a checklist you wrote before you were afraid. This is not financial advice, and please do your own due diligence. Which leaves the question the book puts to you on the last page. If your plan only works when you're calm, is it a plan at all, or just a mood? And there's one argument in the book that the market itself went on to settle. Index funds passed active funds in total American assets at the end of 2023, and by December 2025, they held roughly 19 trillion against 17, while the average active mutual fund now charges about half what it did when he wrote it. The advice won. So of the four faces, the fees, the advisor, the tax bill, and your own head, which one has cost you the most? That's the one to fix first. And I'd like to know which it is.